Hey there, Amplifiers. Manny Torres here, and I've got another exciting episode of Growth Amplifiers. And today I have a special guest, Karl Sjogren. He is the author of the Fairshare Model. It's a really interesting model that I'm excited to talk to Karl about. Karl, welcome to the show.
Thanks. Nice to be here, Manny.
Karl, tell us a little bit more about you and your business.
I do consulting CFO work with startups and companies in a turnaround stage. I'm also, I've done it for a while, and the book came out of my experience as being the co-founder of a company in the 1990s, mid-90s, called Fairshare. And the idea was to make it easier for companies with small, direct public offerings to find investors. It was sort of the original attempt to use equity crowdfunding on the internet.
Excellent. And I know that you got some momentum with it early on, and then the bubble burst of the early 2000s kind of put the brakes on it. But what made you decide to write this book, and who is this book for?
You know, I decided that the attempt at Fairshare was maybe too early. It was a good idea, but sometimes ideas are too early. And I underestimated the amount of time and money that would go into dealing with regulatory concerns. They were solvable, but then, we had the dot-com bubble and telecom bubble burst, as you said. When I saw the Jobs Act get passed and all the talk about crowdfunding, I thought surely somebody was going to pick up on the ideas that we had in Fairshare. But the more I watched for a couple of quarters, I could see all the talk about equity crowdfunding was about new ways to sell stock. Nobody was dealing with an innovative way to structure the deal so that it would appeal more to investors. So you asked who the book was written for. It's primarily written for investors, IPO investors. In fact, I have a little diagram in the beginning of the book to show my hierarchy of interest. And there you can see it there. It's like an Olympic medal stand. So in first place, IPO investors. In second place, there's a tie between pre-IPO investors and entrepreneurs. And in third place, it's the secondary market investors.
That's excellent. And what are some of those challenges that you saw that investors were having that necessitated you coming up with a whole new model and structure for how that can be done?
Valuation. And it's a problem shared by entrepreneurs too. I say valuation, think of it as being put in front of a classroom of sixth graders, and you're asked to rank the kids based on who's going to be happy in life. You're going to have some clues, but you're going to be wrong a lot. And valuation is a bit like that as well. It's very difficult to figure out what's the fair value for future performance. So I would say, I'm noticing the camera is fuzzy on my side. Is it on your side?
It does look a little bit, yes.
Let me disconnect it and then reconnect it.
Okay.
What do I do? There we go. Okay. So I'll kind of take it from the top again. The big challenge is valuation for both the entrepreneurs and investors. It's a challenge in the sense that you might think of it as being put in front of a classroom of sixth graders, and you're asked to rank the kids based on who's going to be happy, who's going to be a success in life, however you want to define that. You'll have some clues, but you'll be wrong a lot. Valuation is a bit like that. It's a lot like that, actually. The Fairshare model is a unique approach to valuation, but it's actually just an adaptation of the venture capital model for private capital to the IPO market. And what I mean by that is that it conditions the ultimate valuation based on what actually happens. You know, you and I might come to you and say, Manny, I have an idea and I need some money. And you say, Karl, how much do you need? I say, I need $1. You say, what do I get for it? I say, I'll give you half the company. We're agreeing if we do the deal, you could add zeros to make it more realistic, that my idea is worth $1 because you're getting half of the company for $1. You'll break even if somebody buys the company for $2, right? But the problem is that you don't know, and frankly, I don't know if my idea is worth $1. Could be worth less, could be worth more. So that's sort of the challenge that is inherent in business transactions, in mergers and acquisitions or buyouts. You see this attempt to become more fair with evaluation with things like a earnout, where the seller can get more value for the business if it performs well after the deal, or a clawback, where they actually give up something that was agreed to if it doesn't perform as well. So this elasticity idea is very common, but it's not common in the IPO market. That's what the Fairshare model proposes to do.
And so with that new model that you're recommending, I think you mentioned it would be a paradigm shift in terms of the general public being able to access some of these investments in a way that mitigates some of the risk that they have for those early stage companies, correct?
Very true. You put it well. I say there's two fundamental risks for investors in this space. One is failure risk, and the other is valuation risk. Fraud is not a new kind of risk. Fraud is just a combination of failure risk and valuation risk served with a dollop of false or omitted disclosure. Failure risk is operational in nature. Is the company going to have a product that comes out? Will customers like it? Will the margins be there? Will the business model scale? Think of it as I'm holding my hand up to the top of my head and I say I'm going to jump that high. Failure risk is the risk I'm going to be somewhere between the top of my head and the floor. Okay. Valuation risk is the risk of overpaying for a position. And an investor can overpay for a position in a company that's doing quite well operationally. Think Tesla, for example. So the genius of the VC model is that, you know, the VCs are better than the average person at assessing failure risk because they're smart and they see a lot. But, you know, even in baseball, the best hitters miss like 75% of the time. So there's room for other people to participate. Where the VCs do really, really well is in managing valuation risk. And they do that by the kind of capital structure they use. I call it a modified conventional capital structure. It's conventional in the sense that it's tradition for a potential buyer to put a value on future performance. You know, get the crystal ball out, see this is how big this is going to be, and then discount it to the current time and say, okay, this is what I think is worth. The problem is no one can do that reliably well. But that's what a conventional capital structure does. It puts a value on future performance. We call it the pre-money valuation. In the example I gave you a moment ago, my idea had a pre-money valuation of $1 before you invest it.
And in terms of, you know, once this model,
I kind of lost my train of thought there. Oh, yeah. I said modified conventional capital structure because VCs and private equity firms have deal terms that modify that valuation. So it allows them to expand their position, frankly, for the same amount of money. If you had invested your $1 in a modified conventional capital structure and turned out that my projections for my idea was 50 cents, you would have had a deal term in that said, hey, you get more shares for the same money. And so you could have a situation with a modified conventional capital structure that somebody owns 10% of the shares and the company's acquired. That shareholder could end up with 20, 40, 60, 80, 100% of the proceeds. Deal terms can be very powerful. So it's a great idea. And that's what the Fairshare model does, is kind of take that concept and applies it to the IPO market. Let me tell you what it is, and your listeners. So it's an idea for how to structure an IPO to raise venture capital. Could be $1 million or $100 million. It doesn't matter. All that matters is that it's venture stage, so it's hard to value reliably, and it's a public offering, so anybody can invest. So the structure is 2 classes of stock. Both of them vote. One is tradable, one is not. Investors get the tradable stock. So that's the IPO investors and the pre-IPO investors. The employees, which includes the founders, get it as well for value created as of the IPO. But for future performance, where most of the enterprise value is, the employees get a voting stock that cannot trade. It converts into the tradable stock based on milestones that the company defines in its offering document, or subsequently both classes of stock agree to. Those milestones could be whatever they want. There'll be variation based on the industry, on the stage of development, and frankly, on the personality of the founders. But broadly, I suggest 5 categories. One is a rise in the market value of the company. Okay. Second would be developmental goals that are significant, like the release of a product, getting through FDA testing or something like that. Operational measures like sales and profits make sense, but so too does the value of the company when it's acquired, if it is, because it's clear at that point how much value the employees created with their labor using the investor's capital. But intriguingly, it can also include measures of social good. You know, you could have a company that's in, say, the eco-technology business, and it's extracting plastics from the waterways. It's not clear what the economic value of that is, but there's a high social value. And there are plenty of investors who would like to support that. So rather than trying to figure out, well, the price of that plastic, you could say, hey, for every £1 million that we pull out, so much of our performance stock, that voting non-tradable stock, converts into the voting tradable stock.
Nice. So it sounds like it has a lot of flexibility and different ways that can be applied, obviously, across different industries.
I think of it as the Linux computer operating kernel. You know, that was introduced as an open source technology in the early 90s, and it changed how computer operating systems were designed. It used to be you had, you know, manufacturers would have their own operating system, and you couldn't really go from one system to another. Linux is open source. There's plenty of variation in how it's implemented. There's going to be similar types of patterns when entrepreneurs use the Fairshare model as well.
Hey there, this is Kenny from Growth Amplifiers, here to ensure you get your awesome ideas into action to grow and improve your business and achieve your full potential. Take the first step by visiting growthamplifiers.com and clicking the Start Here button. Take the assessment to get your personalized score. Then select from free resources to learn how to improve your score. Don't wait. Be proactive and take action now by visiting growthamplifiers.com and clicking the Start Here button. And always keep on amplifying. Now, let's get back to the show.
I think it's a great idea, and your vision in terms of, you know, if this model is introduced and is used, what's that transformation going to look like in terms of how investors, enter different investments, and how many of the general public starts to invest? You see that as a way that it will accelerate the number of investors that are helping these companies?
It will increase the odds that IPO investors make money when they invest in an early stage company. Again, the investors face two fundamental risks: failure risk and valuation risk. I think of failure risk as sort of like the game of roulette. The risk of not picking a winning number is failure risk. Valuation risk is the cost of a chip. The Fairshare model takes the cost of a chip down from, say, $5 to 50 cents or a nickel, so that your average investor who wants to invest in early stage companies can increase the diversification in their portfolio, the venture portfolio, which increases the odds that they're going to have a winner. And it's more fun. So, that's the benefit for IPO investors. For entrepreneurs, by striking a different deal, by basically saying to investors, I'm not going to charge you up front for my future performance, but if I actually perform, I'm going to dilute your ownership. You're going to pay one way or another. You pay up front in a conventional one. With the Fairshare model, you pay when the performance is delivered. No free lunch here. But the promise for an entrepreneurial team is that a well-performing one can end up owning more of the wealth that they create with their labor using the investor's capital than a venture capitalist would allow. So that's sort of the central benefit, I think, is that it encourages an entrepreneurial economy where there's risk-taking, but there's a focus on achievement of goals. And there's going to be fallout, but there's going to be more winners. And it sort of fosters a sense of optimism, I think, in the economy.
I think from what I understand of it, it also builds a little more stability, right? Because people are not just thinking short term, they're thinking long term, and they're thinking about those different milestones, and they're not trying to get that quick accelerated growth. Maybe they're thinking more of sustainable growth and how they can have the whole team as part of it, because there's those incentives that you mentioned before that can be baked into it. So I think I
couldn't put it better than you did, Manny.
Well, it sounds like a fascinating idea and a great model. Karl, if one of our listeners is out there, wants to learn more about the Fairshare model, what's the best way for them to connect with you and learn more?
Well, they connect with me on LinkedIn. I'll share information. I put articles out there every so often. You could go to Amazon.com and look at the preview. There's a fair amount that could be previewed. You can also actually see a bigger preview of the book using Google Books. But this is a movement to reimagine capitalism, to make it work better for average investors and also for startups. And it's not necessarily going to be restricted to startups in Silicon Valley or Route 128 or something like that. It could be used across the world. And so that's what this is about. It's an experiment in innovation in venture capital that deals with, I think, the central economic challenge of this century, which is, can the benefits of capitalism be more broadly and fairly realized?
I love it. And I think it's a great idea. We'll make sure to put a link in the show notes to the Amazon preview and also to your LinkedIn profile. Karl, one tradition that we have on our show is for you to share something, whether it's business related or personal related, something that you've learned along your journey in life that you feel would be beneficial for our listeners to learn about.
I remember reading the beginning of a book by some guy it was sort of a vanity book in the early 90s. He had done well and he was trying to talk about his success. But I loved the opening page. At some point, he talked about a 3-stage process that one needs to go through if they're going to be a success. And the first one was, put yourself somewhere where things are happening. The second step was, recognize you're there. And then the third step was take one step after another, to be productive. And I always love that second step. Recognize you're there. If I look back at time, I've been placed oftentimes in places that were happening or things that were happening. But sometimes I didn't realize I was there. And, this ferment that we always see taking place in cycles in the economy represent times and places where things are happening. But darn, so many of us don't realize that we're there until it's actually passed. So I would encourage listeners to just think about that, and whatever it means for them. And the logical steps of what to do at that point sort of just become apparent. But put yourself somewhere where things are happening and realize you're there.
I like that a lot. And that's a great reminder. There's so many cycles that go on in life, whether it's your own life or, the economy or just mankind in general, just taking a moment, check out the landscape, understand where you are and where you fit in that cycle. I think that's an incredible insight there. I appreciate you sharing that, Karl. Thank you so much for being a guest on our show today. We'll make sure to put links to all your information on the show notes. And thank you everyone for being part of our show today. And we'll talk to you soon.
Bye, everyone.
To show your support, take a moment to amplify this message by sharing it online. To connect with me or gain more business growth insights, visit www.growthamplifiers.com. Thank you for your support.